When you see 100% finance advertised or 100% loan to value, you might think, happy days, I don't need any money, I'll just borrow 100% to buy this property. Or if you're like us, you might think, what's the catch?
Bridging lenders won't give you 100%. There's always a catch. Anyone that says so, please read the small print. There's always something that they aren't telling you. We run our own finance brokerage, exclusively arranging bridging loans for property investors and developers. So we understand what the lenders actually want and what they're looking for, and also ways that this is possible.
There is such a thing as no money down property deals, but it's not always as easy as it's made out, and it's certainly not for everyone. So there are two ways, or two routes as we like to call them, on how these deals can be done.
Route 1, buying the property below market value. Buying the property below market value means you're able to buy the property at a lower price than the property's current market value. This often happens when the vendor needs a quick sale. For example, say the property is worth £350,000, but they will accept 20% less, so you can purchase for only £280,000. Some lenders will lend off the open market value regardless of the purchase price, but most will still have a restriction in place with regards to their leverage.
Also, this 100% finance is often in relation to the property's purchase price or value. You will have fees to pay which are associated with the loan, such as stamp duty, a third-party valuation, and both sets of legals, so yours and the lender's, unless you go down the dual representation route.
This higher loan leverage means higher risk for bridging lenders, so you often be paying a premium to access this type of loan. For example, you're paying a higher interest rate. You may be thinking, are there really these type of deals on the market? The answer is yes. They are derived from what's known as motivated sellers. The key is everyone should win. So if the seller will win as they need a quick sale, which you can help them with, and then you'll win because you get to buy the property at a discount.
Route 2, using other assets. This is where you don't have liquid assets like cash, but you do have equity tied up in your own properties. So in this instance, the lender will take another legal charge over the other property or properties if more than one is required. You don't need to refinance necessarily, i.e. get the cash in the bank. The lender will instead take a legal charge, which is also called a cross charge, over the additional security you are providing to get to that 100%. This can either be via a first or second legal charge.
Side note on this one, the lender can only take a charge if you actually have equity available. For example, if you have a buy-to-let investment property with a buy-to-let mortgage of, say, 75% loan to value, the lender won't be able to take a second charge as you're already in a high leverage position. Also, the first charge lender would need to provide consent to the second charge lender sitting behind them, which they don't always allow.
Exit route. As with any short-term loan, like a bridging loan or development finance, you need to make sure you have a very clear exit route available, so a way of repaying the loan. You might be thinking, why do I need to go down the bridging loan route in the first place? Well, because bridging loans do have a place in the market, often for specialist, quirkier projects that need a short-term facility, as a long-term facility in this instance is not available.
Bridging loans are more expensive by default as they are fit for purpose. They are bridging a gap whilst you take one of the two exit routes available. So first route is you either sell the property to repay the loan, or the other route is you refinance the property onto a longer term loan.
Say you wanted to flip the property, so sell it. An example is you may have the opportunity to buy a property below market value as the vendor needs a quick sell, which most people cannot accommodate with unless they are either a cash buyer or using a bridging loan. Most buyers will use a traditional mortgage, which takes a lot more time and it's not an ideal situation for the vendor who needs the cash ASAP. Whereas you can step in, use a bridging loan, buy the property and put it straight back on the market. See, this is if you feel that you'll be able to sell within the bridging loan term at the market value.
Say you were able to buy the property at 20% below market value and your exit is to sell, you won't get the full 20% discount though overall, as you'll still need to account for legal fees, the valuation fee, the loan interest, but it is a nice strategy and a paper one, as we like to call them. Sometimes you don't even need to do any works to the property.
The other exit route is to refinance, where you want to keep the property and seek a longer term loan, such as a buy-to-let mortgage, which are often at half the interest rate.
Experience. This isn't often for first-time investors or developers, as lenders generally ask for experience in the strategy that you're undertaking. However, if the deal is good and there's a good story or legitimate reason how you came about the property deal in the first place, then don't completely write it off, as it might be possible.
No extra security. If this is your first project, or if your other properties are already at max leverage, you won't have any further equity to use to support the balance that may be required.
Personal guarantees. Most property investors and developers will buy their properties via a limited company or a special purpose vehicle, an SPV, as they're sometimes referred to. Most lenders will require the applicants of the loan, who are often the directors and people with 20% or 25% or more shares in the company, to provide a personal guarantee or a PG, which effectively removes your limited liability. And these type of strategies are high risk, so you need to ensure your exit route is very strong.
Bridging only. This type of finance refers to a bridging loan unless you are self-funding any works required to the property. This isn't really applicable for refurbishment projects or development projects. The loan for these types of projects are often calculated using the loan to GDV metric, not the loan to value.
Property type and location. This may not be suitable for every property. A lender will have other points to assess as part of their normal lending criteria before they even look at the potential loan details. For example, the property and the type of property and the property's location.
You may have a lender that can support 100% loan projects, but won't support properties located in Scotland, and they have a minimum loan amount of 500,000. So say your property is based in Edinburgh with a purchase price of 250,000. It's irrelevant if they will support 100% loan, as the property doesn't even meet the first part of their assessment.
Using the wrong broker. You need to ensure you use a finance broker that specializes in bridging loans like we do. Finding the right bridging lender can be a challenge in this area, as one, there are a limited number of lenders available, so the lending pool is smaller, and two, they all have different lending terms, so don't just look at the interest rate in isolation.
Not only do you need to know which lenders support 100% loan, but you are still effectively pitching for the loan. So the negotiation and application process is a skill. Unless you are certain you know what you're doing, going direct to a lender can actually go against you.
Finding a specialist broker that knows what lenders will do this type of deal and will have direct access and hopefully a relationship with the lender is priceless. They will be there every step of the way with you, from the loan application right the way through to completion.
A good broker will guide you in the right direction. A bad broker could cost you £1,000. So if you have an opportunity similar to this and you want to know your very own loan route, then please visit our website, which is www.nextroutefinance.co.uk. And that's also noted in the description section of this video. Thank you very much for watching.